Morning, everyone. Thank you for joining us. We're actually getting started right on time at 11 today, so that's awesome. I love seeing the cameras on, so if you guys are able to, feel free to turn them on. I'm sure Sean would love to talk to more than just a bunch of black squares. So today, Sean, Don, and Chris from Cross Country Mortgage are going to be talking to us about ARMs, buydowns, and points. So I will let you guys just take it away.
All right. Thanks, Carrie. Thanks, everyone, for making it. And I know many of the faces I see have been in these classes before, so feel free to please don't raise your hand, just start talking and we'll hear you. Chris is on. Don will probably be on here shortly, if not already. And Chris, Don, obviously feel free to chime in anywhere and let me know if I'm missing anything in the chat box as well. As we go through, I'll share. In fact, I'll do it now while I'm thinking of it. I'm going to throw the PowerPoint in a PDF form just for your own information. There's some other flyers and such that we have regarding the buy down. I've sent that before, but I'll put those in the chat box as well, just so you guys have something kind of quick to reference for your own. So I'm going to go ahead and do a share screen if that's okay. Actually, before doing that, let me go ahead and two more in the chat. Okay, so we've got a few things going in the chat. Are you guys seeing that document in the chat box to download?
Yes.
Okay, cool, thanks. Okay, so
Sean, I don't think it's letting you download it though.
What's that?
I don't think it's allowing you to download it.
Okay, I just put those in there. We'll try, give it a few minutes just to see. Okay. It might still be uploading.
Got it.
If not, we can send out an email with all these files afterwards too.
Okay, cool. Thanks, Carrie. Okay, so kind of just for the first few minutes, just to run through some basic stuff here, just as we wait for the crowd to pile up. Our web pages. So if you go for me, ccmgreatercleveland.com, and I'll have Chris and Don's information here in the back end as well. But our web page has some great tools. I know a lot of buyers will go here to start the application, but you go to the resource center. We've got kind of blogs. We're featuring VA loans this month. You can see articles and such over. Actually, you do a quick search. If you do Buydowns, which is a topic we'll have today, that'll pop up. What is a buydown? What is an interest rate buydown? What is a 2-1 buydown? This webpage has been really revamped over the last 6 months with some really good content, but current content as well. So I would suggest everybody feel free to check that out, bookmark that. Also, while we're at it, want just to chat about interest rates. What I pulled up here, Mortgage News Daily, it's a site I've referred to during our Tuesday meetings and in each class I do, just to kind of get a feel of a temperature of where the market is at. So the 30-year national average, this isn't necessarily cross country's rate, but just to give you kind of a feel, 7.22% is the national average on a 30-year fix. So figure about 7.25. We did get good information this morning, good news, I should say. Inflation reports came in slightly better than expected, and that is, we'll take that as great news, because just about every inflation report we've seen for the past year has been negative or trending towards the negative. So we'll see maybe some modest improvement here in the very short term. The market's going to be slow to give back these benefits, but we'll keep an eye on things. And this is kind of the 30-year fix. This is over the past 12 months. Where rates were a year ago is just over 3%. Where they sit today, just over 7%. So just to give you a little feel on that. If you guys want to discuss rates further at the end, we can go into that, or of course, always feel free to reach out to myself, Chris, or Don. All right, with that being said, we'll go ahead and give our presentation a go here. And is everybody looking at kind of the presentation full screen title? Okay, cool. Thanks, Carrie. Thanks, Carrie, again for the 5-minute, pre-Zoom coaching here, just to make sure it all looks right as well. So slides going to have about 20 pages, 20 slides, and first one's kind of a gimme, as is the second one. So you see my face in the upper corner of your screen already, but that's me, slightly outdated picture, but all my contact information. So really what this meeting is about, ARMs, buydowns, and points, oh my. So ARMs have been around seemingly forever, as have buydowns and points. And there really hasn't been high chat about these or high demand for these options because interest rates had been so low and we were in a buyer's market. As we're working towards this shift, you'll start to see and hear more about these. So it's pretty much a deep dive education on what those are. So in the market here, and thank you, Chris. Chris was able to put this together. Basically, just objections that we're seeing. Actually, here are the objections, and then here in red are the solutions or answers. So we won't jump in. We won't hit on all 9 of these, but just to kind of run through a few. And then, as I said, we'll make sure that you all have these just sort of the reference. But it's too expensive. There's no way I can afford a home. This is the first one, number 1. There's no way I can afford a home with how much housing prices have gone up. Well, gross pre-tax income is used to qualify, and your monthly payment could be comparable to less than what you are paying in rent. One of the final slides we see is going to be kind of a buy versus rent form, and that is a big one. How about number 2, section middle column, the middle one? I saw on the news that interest rates have doubled. Shouldn't I just wait to buy? Now is always the best time to invest in your future. Rates will always go up and down, but the sooner you start building equity for your future is the better. So just some quick good little guides here, and then the third one I like. I have good income, but I don't think I have enough saved up. Your down payment doesn't always need to come from your savings account. You can receive a gift from a relative, loan against your 401k or life insurance, or you can qualify for some down payment assistance programs. So there are statistics out there. I think you as a realtor are probably, mind is boggled as much as I have, but the biggest myth still out there, more than half of people think that you need 20% down to buy a house. I hope, and I think everybody already knows on this call, but 20% down is absolutely not required. 3% conventional, 3.5% FHA, VA 0, USDA 0, and there are down payment assistance programs in there as well. So anyway, we won't get too much into that, but just wanted to throw these out at you. So we're going to start with ARMS. Just again, keeping it simple, ARMS stands for Adjustable Rate Mortgage. First time home buyer doesn't even know that in many cases. So what determines the, actually reading the first line here, interest rate is fixed for a predetermined period of time and then becomes adjustable based on the index and margin. So the next, let me just jump ahead here. So I'm going to give an example just because the easiest way to show this, but if somebody has a 30-year fix today, let's just use round numbers at a 7% interest rate. They know what that rate is going to be now, next month, next year, and year 30, if we do just a simple 30-year fix. So this one is a 7-1 ARM. So how this works, it's still a 30-year mortgage. It's fixed for 7 years. And then after that 7th year, that rate is going to adjust. And it's going to adjust every year after that in this particular. So the loan is based off the CMT index and has caps of 5.25 and a margin of 3%. So I just want to explain what each of these are. So let's say in this given ARM, the start rate is 6%. That is what the interest rate is going to be for the first 7 years. It's fixed. We know exactly what the principal and interest is going to be for those 7 years. After the 7th year, it's going to adjust. The CMT is the Treasury. There's you can Google it, you can look in the Wall Street Journal, but let's say after 7 years, the index, going back to this page, the index, this is the part we're using that's variable. We take that plus whatever the margin is. And for most ARMs, your margin is going to be 2.5, 2.3/4, 3%. For simple math here, after year 7, if the market Treasury is at 4% plus the 3%, that buyer's interest rate in year 7 goes to 7%. So it's 6% for the first 6 years. After year 7, kind of using this scenario, the rate goes up 1%. And then for the 8th year, this same thing happens again. So after the 8th year, let's say that the index is at 5% plus 3. Now their interest rate is 8%. So in this example, the rate is going up. But guess what? These rates can also go down. So if I'm talking to a buyer who says, yep, I'm going to be in this house for the rest of my life, we talk about an ARM and say, okay, well, you got a 30-year fixed at 7%, or you can do a 7/1 ARM at, say, 6%. They may want to seek out this opportunity to save on those 7 years with the understanding that rates may not come back down. And in fact, after 7 years, you're going to lose that 6% interest rate and go to effectively the current market by way of this ARM. But for some in the population, some home buyers may not think that's too risky. They may say, you know what, it's my first time buying a house. I'm only going to live here for 5 years, 6 years, 7 years tops. I'd love to jump on this ARM and take advantage of that lower interest rate. There's not much risk for me in the long run. You never know. Where we do a lot of ARMs is with residents. You have a lot of people who are moving to Ohio to complete a 4-year residency at maybe UH or the Cleveland Clinic. After 4 years, they're going to be jumping up to a doctor's salary, or they may be moving back out of Ohio. So they may look at a 7-year ARM and think, hey, this is pretty low risk. Unless I stay here for several years beyond, I don't have to worry about this adjusting. And then, of course, you have people who maybe plan on living in this house for the rest of their life, but they're counting on refinancing. So they're going to, kind of risk it. I'm going to go with an ARM with the hope or expectations that rates will dip within 7 years. I can refinance at that point and get to a lower interest rate. So,
Sean,
yep.
Can we add one thing here?
Yeah.
A couple of items. One, the caps throughout the life of the loan don't ever change. They're 5.25 life of the loan. The margin does not change over the life of the loan. It'll always be, if it's 3%, it's always going to be 3%. The only item that changes on this product is the CMT index, which changes daily. So over the course of 7 years, that number is going to vary daily. And when it comes time, I think it's 45 days before reset is when they figure the new rate. 45 or 90, which is it, Sean?
I think it's 45.
Yeah. So whatever the 45th day is before the rate's going to reset at the end of the 7 years, that's the CMT index they're going to use.
Good one. Good touch. The caps, by the way, and I started to get away from that. So the caps, the 5.25 cap, and I have a kind of down here, I should put bullet points there, but basically saying after that first adjustment after 7 years cannot go over the start rate plus 5%. So it could be pretty brutal. 11%, that's the ceiling on that first adjustment. Now, each adjustment after that can only go up 2%. And then the lifetime, the ceiling can never go above 11% in this given scenario. So there are caps. It's hard to gauge what's going to happen. Obviously, with interest rates here moving forward, nobody knows what the new norm is going to be. So there's definitely some risk. But what we do as loan officers is educate the buyer just in what's available to them: fixed rates, adjustable rates, not just 30-year loans, but 20-year and 15-year loan options, and measuring these up. ARMs are in almost all cases going to be 30-year amortization, just to clear that up too. So, Donnie, Chris, anything else you guys have to add?
In my opinion, I think one of the best times to take an ARM product is in a rising interest rate market, because you're catching everything on the high end, which means just in the future, more than likely, you're going to adjust down, stay the same or adjust down.
That's exactly, when I'm talking to a customer, I say, rates, typically there's going to be peaks and valleys. We're on our way up in a pretty big hump. Now, are we at the top? Is 7.25%? Is that the tippy top and they're going to come back down? Or are they going to go up to 8 or 9 before they come back down? Nobody knows that. So the ARMs, this is exactly when you start hearing a lot about it, is they're kind of looking to chase and get yesterday's interest rate. And the ARM is a way for the buyer to take on some long-term risk if that doesn't happen. So,
plus, in like a less volatile market, ARMs tend to be a little lower than a 30-year fixed, right, guys?
Yep.
Yeah.
Yeah. I mean, with the inverted yield curve and kind of the influx economy, the ARMs don't track the reward. The 6% 7/1 ARM I put on there, that's probably not all that realistic. The 7/1 isn't quite that low. I put it on here more just for simple comparison, but yeah, you're right on that. Is in the market that's going up as fast as it has, the ARMs aren't quite as attractive than in kind of a ho-hum, stable, flat market. Cool. So this one just talks about some of the pros, and we kind of touched on it already, but obviously the benefit, you may obviously be getting a better interest rate than the 30-year fix. There is the possibility of those rates going down. So way back in 2004, 5, 6, 7, if you got a standard conventional loan, not a subprime loan, but a conventional loan with an ARM, you may have ridden that ARM out for 3 or 4 or 5 more years after the adjustable rate period, just because the market had, all the indexes had dropped again, and people were capitalizing. People had interest rates, when a 30-year fix might have been at 4 or 5 or 6%. Some people were sitting pretty in the 3s on some of these adjustable interest rates. So it's not always, the rate doesn't always go up. When I'm talking to a customer, I typically say, hey, if you're making a long-term decision, not knowing where the world is going to be in 7 years, that's a safer way to do it. Cool. So that's what we had on ARMs. Seller credits. So as we get into points, we're going to talk a little bit about PMI and the buy down. This is where seller credits come in heavily to play. Actually, before any other questions on ARMs before I move on? No. All right, cool. And I see. All right, thanks, Don, for jumping on the chats there. 39 people. Whew, this is exciting. I'm glad this wasn't a lunch and learn. We'd probably be out of pizza by now. But thanks everyone for coming. So seller credits. So seller credits, seller concessions can be applied towards points, towards PMI, towards a buy down. So we'll talk about that in the next few slides. But just to make sure we're clear on how much concession, how much of a seller credit we can get, FHA allows for a 6% credit. So on a $100,000 house, the seller is able to give 6% back to the buyer. I said seller, but this can also be realtor, so total concessions. I know realtors, it's not commonplace to give concessions to a buyer, but we've come across some interesting transactions over the years. And before we're done here too, I'll mention an example where a realtor asked, hey, what if I do this? Kind of interesting concept. But again, FHA, 6%. That means on a $300,000 house, you can ask for $18,000 in seller concessions. That's probably overkill, but just letting you know what the limitations are. On conventional, you can do 3 to 9%. The amount of seller concessions varies. The limit, I should say, varies based on the down payment. So if you have a conventional buyer putting less than 10% down, 3% is the limit. If you're putting between 10 and 20% down, you can ask for 6%. If you're putting more than 20% down, you can get a 9% concession. So again, that would probably be overkill. Frankly, going above 6% is pretty rare, but for a lower price home, you might bump into that. 2% on investment properties, and that'd be conventional, and 4% on VA. So this, I often, especially if you're a newer agent, or maybe you're not a newer agent but haven't worked with concessions and seller credits much, feel free, obviously, pocket this little presentation. But this is the stuff, Sunday at 2 o'clock, I'm running kids around doing whatever. This is often the call I get, either, hey, can you do a rush pre-approval, or hey, I'm putting in an offer. What's my limit? How much should I be asking for closing costs? Always feel free to reach out to us, for a quick little guidance on that. Anybody have questions on seller concessions and those limitations?
No. Sean, I do want to add on VA. The number technically is more than 4%. The 4% goes towards certain items, but you can get up to 6, 7, 8% on VA, and you can use that money to pay off the veteran's debt or collections if need be. That's the only loan you could do it for. You can't pay down or pay off debt for a buyer on any other product aside from VA. So another benefit of the VA loan.
Yeah, and as a reminder, tomorrow's Veterans Day. If there's any veterans on this, make this your niche if it's not already. VA loans, that is. Well, we could circle back to that at the end too to chat a little bit more time. But VA loans, just unbelievable loan. I forget sometimes just how big they are and how much they can help customers, veterans, I should say. Okay, so now we're going to jump into a buy. So I'm just going to kind of skim this for us, but Temporary buy down is a closing concession available for primary and second home purchases. This doesn't apply on investment property. Enables a buyer to have a lower interest rate for the first 1 or 2 or technically 3 years and ease the buyer into the payment. We'll see an example here to illustrate that. The builder or seller, and technically realtor, will fund a temporary buy down, but it'll need to be included as an agreement in the purchase contract. So it has to be written in the contract. And the real estate agent negotiates it during the offer process. The prepaid sum is paid during the closing into an escrow account. The lump sum is held in a custodial account and is applied to the buyer's payment. We'll illustrate that in the next couple of slides here, but the buyer will have a reduced monthly payment. The difference, that reduction in payment, that difference, it comes out of this pre-funded escrow account. So what we're going to look at here, these are the different buy down options. Technically not limited to these, but these are the ones you're going to see. A 1-0 buy down. So how this would work is, again, just use a nice round number. Let's say, actually, I'll make it consistent with the next one. So let's say interest rates are 7%. If somebody doesn't do a buy down, we know the interest rates, the payment's going to be based off that 7% interest rate now and forever for the next 30 years moving forward. What a 1%, 1-0 buy down is buying that rate down 1% for the first year. A 1-1 buy down is buying that interest rate down 1% for year 1 and year 2. So a 1-1 buy down means their payment is going to be based off of a 6% interest rate for year 1, 6% interest rate for year 2, and then it's going to fall back or climb back to that 7% for year 3 through 30. 2-1, obviously, I think you guys get the pattern here, buying the rate down 2% for the first year, 1% for the second year, and then all the way back. And then, believe it or not, there's a 3-2-1. So if today's rate 7%, they'll get a 4% for the first year, a 5% rate for the second year, a 6% rate for the third year, and then back to 7% for year 4 through 30. So again, I'll show the illustration, then we'll kind of get in kind of on a more bigger scale on where these become available and the practicality of when we would be using these. So this is a 2-1 buy down. So in this example, we're using a $250 sale price. We're putting 20% down. This is just for simple math at $50,000. We're borrowing $200,000 and the interest rate is at 7%. So in this 1 year buy down, sorry, I have to keep moving your faces because it keeps covering my screen, but I like seeing people nod and stare and laugh at my jokes. So in year 1, we're looking at, thanks, Elliot. So year 1, we're at a 6% interest rate. The payment is set at a 6% interest rate. So roughly $1,200 on the principal and interest, where year 2 through year 30, they're at $1,330 a month. So the cost of this is just under $1,600 on this $200,000 loan. Is, hey, I'm a buyer. I've been shopping for a house since early summer, and way back then rates were around 6%. And oh, by the way, I wasn't thrilled with that. Now here we are at 7%. Well, what's also changed from May, June to now is you've got sellers probably a little bit more willing to help out with some costs and concessions. So how nice would this to be to say, hey, as a buying agent, yeah, we're going to negotiate a full price offer at $250,000. Can you give us back $2,000 or $1,600 back in seller's concessions? With that $1,600, look at the difference you can make for this buyer. You can lower their payment $130 for the first 12 months. Certainly that is a, very enticing offer for a buyer, especially somebody thinking, oh, geez, I wasn't really comfortable with that $1,330 payment. I'm going to have to talk myself into it. Well, hey, you don't have to talk yourself into it. That is going to be your payment. But what if you were able to, through the seller assistance here, able to lower that payment to $1,200? I think a lot of buyers are going to say, you know what, I think I can live with it. I'll grow into that payment. We still qualify them off of this $1,330 payment, by the way. So that's still what we base everything off, kind of long term. But you can pretty easily see, I mean, this is not even a 2% concession. It's not even a 1% concession. On a $250,000 loan, this is about 3/4 of a point. So I know I this seems, as I explain it, pretty easy, but I know if you're not familiar with the concept, it can be a little complex, especially for a home buyer. But to the 10 faces I see on the screen, does this kind of make sense where we're coming up with that? Okay. Let's jump over to a 2-1 buy down. So this is obviously a little bit more expensive, or excuse me, a little bit more, well, yeah, I guess the cost to make this happen is a little bit more, but look at the difference in payment. So 2-1 buy down, we're at 5% for the first year. We haven't had a 30-year fix in the 5% since spring, probably right around the beginning of the Indians start of the season. And those days are long gone. 6% rate for year 2, and then we're at back to the 7% interest rate for year 3 and beyond. So obviously this could be a game changer, saying, hey, for $4,600, so that's still less than a 2% seller concession on a $250 sale price. And this doesn't have to be on 20% down. This could be on 3% down, 5% down, FHA, 3.5 VA. These are eligible in all primary residence options and second home programs. So if I'd be surprised if anybody on here hasn't seen kind of on a listing, kind of as a little bit of an enticement, buyer will lower or seller will, finance or lower buyer's rate 1% for the first year, or do a 2-1 buy down. We're starting to see this in MLS, sort of in the comments and such, to get people's attention, and you see why. Getting a payment for just under $1,100 when it's supposed to be or going to be over $1,300, and it just, this simple math on how we calculate this, your friendly neighborhood loan officer is able to calculate this within minutes and tell you exactly what it can be. Now, I mentioned before,
the way the realtor needs to sell this to the seller is, this is a better option than reducing a house by $5,000 to $10,000 if it's just sitting there not getting any activity. If you put out this option, this product, you get, just like Sean said, this is less than 2 points on a $250,000 house. That's $4,600, as you can see there. Why drop it 10 grand to try and entice someone if you can lower their payment by $250 a month, $4,600, less than 2 points. So this is a better option than reducing the sale price of the house.
Yeah, just think, if you're doing a $10,000 price reduction, you know better than I do how big of a splash that makes in the market. But just to say, you know what, before we go there, let's just offer a 2-1 buy down. That's in this example, a whopping 2%. That's $5,000 as opposed to $10,000, and you may get a little bit more. It's certainly going to open up the market to more buyers. I had an agent ask me, I mentioned about how, this can be come from the realtor and seller, or excuse me, the seller, but concessions can also come from the realtor. So I had a realtor ask, so let's say I went to my seller and said, you guys know the better idea of what comp splits and commission split, the real estate commission. But this agent said, so I was just going to ask for a flat 7% and tell them that I would pay for a buyer's 1-0 buy down. That would be available. I said, yes, it would. I didn't even think of it. The agent kind of thought of it, but I thought that was an interesting marketing piece to say, hey, the agent's going to fund the 1-0 buy down for whatever buyer walks in the door, and they get to advertise that. So that was a realtor spin, is that, speaking as a realtor, that's going to make it easier for me to market your house. So that was smart.
You got a couple comments in the chat, Sean, if you want to check those out.
Yeah, cool. Let me jump on. So this is only value if the buyer is disciplined with their financing, budgeting, jumping up. Oh yeah, believe me, 100%. We don't just, I could speak for the three of us. I certainly can't speak for all loan officers in that, oh, here, this is a good way to, your payment's only $1,000, kind of sell them on the lower payment without that end payment being in mind. Conversations that we have are pretty in depth. We're not, the call center type, just sort of say whatever we can and go script crazy just to get them to the finish line. Yeah, we have a conversation with the buyer that said, hey, just like an ARM, if you're making a decision on the ARM, know what the consequences can be later on. If you love this 2-1 buy down, just know these payments are scheduled. Your payment is starting off as this, And you know, looking at this example, we'll jump to this and then this. You have to be prepared for it. That's why we qualify them at the end number. You know, there's no smoke and mirrors going on, you know, with us, I can attest to, to make that clear. And there's some additional buy down documents. So as in addition to your, you know, several documents and disclosures, the loan estimate, which breaks down all the costs and fees, there's an addendum or an additional document specifically saying what happens to this buy down. And one thing that does come into play, a lot of thoughts are, okay, well, what if I refinance? You know, what if rates drop and plummet to, you know, 5% in 2 years or in 12 months? Let's use that example. And if rates go down in 12 months, oh geez, is the buyer thinking, oh man, I gotta, you know, sit there and ride out this 2-1 buy down. You can refinance this loan at any time, and the unused portion of this $4,661 on the screen here now, let's say that only 1 year into that, they're refinancing. That other $3,000 that didn't get used, that goes towards their principal balance. That's their money. That goes back towards. It's not, we'll get into points in a second. Points are costs spent up front and, you know, not recouped. There might be some tax benefits, but you can't recoup those on a refinance. In a 2-1 buy down, right down to the penny, whatever's left in there goes back towards the principal. So the other comment, how does this compare with the basic seller credit, since the DTI is still based on the full payment? So this is treated just like the seller credit or seller concession. And looking at the payment here, if the buyer only qualifies for a $1,200 mortgage payment, this program isn't going to work because they have to qualify on that $1,330 payment. So I'm not sure if that's exactly what the question was, but if not, please just.
Yeah. I guess it's just like looking at the total amount that's credited at the end of the year or the 2 years. If that's within the allowable limits, then it's more like, okay, it's comfortable on the payment, but if you could credit that full amount and they don't blow it, then they could just say that goes towards their mortgage if they wanted to, or I mean,
There's
are
no
usually trying to see how much on the
opportunity.
net they save. It's the same, right?
Go ahead, Don, I'm sorry.
I said there's no opportunity for the borrower to blow it. The money's placed in an escrow account from the seller's proceeds.
Oh yeah, no, I'm saying as opposed to a seller concession towards buyer closing costs, points, prepaids, like.
And there's still room to add some of that in there actually, because this is less than 2 points, you know. And if you bump this up another $4,000, that might be, you know, 3.5% concession. So you can cover not only the buy down, but you can cover closing costs.
Yeah, I mean, supposing you have a seller who's willing to do it, but like given your choice between the two on the net, it's the same to the buyer or the seller in terms of total dollars.
Yeah. I think that's the big thing for sellers. The enticement is, you know, hey, you get to throw a deal out there without having to take it on the chin by lowering your, you know, your purchase price by 10, 5, 10, however much you were going to lower it to try and entice buyers in. The upcoming slides, I believe, too, is the point side of this, which I think is another really good. I think that might answer the other side of your question, where if we have the seller concession, we use it towards points, you know, that lowers their rate for the full 30 years. What does that look like? And then you're qualifying them off of that rate. So not to set you up, Sean, but there you go.
What a beautiful segue.
Lob this for you.
Yeah. But what a beautiful segue. But before that, one more final thought. So on this last one, let's say for this $250,000 house, and this example, they're putting 20% down. Let's say they just got a 3% seller credit. That's $7,500. So roughly $4,600 here can go towards the buy down, and the remaining, you know, $2,300 and change that can go towards other closing costs. So, you know, we'll make sure every penny is spent on that. So, speaking of where other pennies can be spent, what are points? So I'll fly through this one pretty quick. By the way, let's see here, just making sure. Yeah. So this is slide 13. I'm the type where I want to know how many slides are on a presentation, how many are left, kind of gauge here, but hoping to wrap this up within the hour as well, just a side note there. But discount points are fees that can be added to the buyer's closing costs in exchange for reduced interest rates. That lower interest rate would be locked in for the full term, 15, 30 years. There's 10-year loans as well, or until they refinance or pay off the loan. Given the volatility of the current market, points are less expensive than we usually see, and we'll illustrate that here below in this slide here. So this is just an example to kind of illustrate how the numbers would work. And when we're working with a customer, especially when we kind of usually have a price point in mind and sometimes already exact with a contract in hand, this is a little bit easier kind of to gauge and explain. But in this example, let's say that interest rates are at 7% and that's paying 0 points. And let's say that we give the buyer the option to say, hey, if you want to pay 1 point, we'll reduce that interest rate by 0.5%. So by paying 1 point, you're buying down the interest rate to 6.5%. So we don't have the whole payment breakdown here, but just to keep it simple here. So you're paying 1 point, which is 1 percentage point of the loan. So in this example, you're paying $2,000. You're getting a 6.5% interest rate, and the savings there ends up being $67 per month. So if we do simple math, let me just pull up my handy calculator here. If we gave the buyer to say, hey, if you pay $2,000, we will drop your interest rate at 0.5%. You'll save $67 a month. You will recoup that expense if you're just looking at the simple cash flow analysis in 30 months. Do you think you're going to be in this house for 2.5 years? Do you think you'll have this mortgage for 2.5 years? If so, paying points will benefit you right up front with that initial, lower payment, but over the long term, you'll recoup that within 30 months, that upfront expense. Now, technically, your amortization schedule moves along a little quicker, so you could argue that the recovery or the recoup time is even lower than this, but this is just kind of the simplest way to explain it. So usually in a normal flat market, we say 1 point typically lowers your interest rate about 0.25%. The market we're in, with rates jumping up as fast as they have over the last 12 months, this 1 point sometimes is getting us 3/8, sometimes even 0.5%, especially on government loans like FHA and VA loans. So this can be, obviously, buyers have the option to pay points in all cases, but this can also be funded by the seller. So earlier this year, I'd say earlier this summer, I should say, we heard a lot of people talking about, hey, you know what, how much will it take to pay down point? You get more bang for your buck in the upfront kind of first couple of years with the temporary buy down. These points are buying it down for the long term. Now, points aren't quite as popular as the buy down because a lot of people, for this break even of being 2.5 years, there's a big chunk of people who think, well, I'll be refinancing in less than anyway, so I'll just keep the money, or I'd rather do a buy down instead. But does the concept of points, does that make sense the way I worded it there? Okay. So just know that every customer we talk to, we're having a conversation about points. I had a gentleman who's been pre-approved for 3 months. We had talked about points in the very beginning just to kind of explain how it worked. Well, I just quoted rates from this morning, and I said, here's where your rate is at, 6.875, 6.75, and he's kind of that walking Excel spreadsheet. So he's got a whole Excel spreadsheet where he's doing his little cost savings analysis. He also is confident he'll be refinancing within 3 to 4 years. So he's going to do his own math and make his own decision, of course, but wanted to educate him on those.
Hey, Sean, Nancy has a question. Does other language in the contract need to be used for a temporary buy down? We usually say seller credit towards points, prepaids, and closing costs.
I would throw in there and buy down. I think most lenders were able to work with that without that being in there. I did have someone write in, seller to pay for to fund buyers one year 1% buy down. The only thing that which is fine, but the math on that, well, if the buyer puts 5% or 10% down, the math on that moves. So just saying, it's sort of like just saying seller to pay buyer's closing costs. There's no set amount. So usually I would suggest, talking to your loan officer, hey, we're getting a 1-year buy down. Is $3,000 going to cover it? Yep, $2,700 is all we need. I would suggest seller to credit $3,000 towards buyer's closing costs, prepaid points, and or buy down. So having that extra word in there gives us the flexibility to apply that. And keep in mind, different lenders may have different requirements, but I think that's the easiest and most blanket approach to do. So good question, Nancy. Okay. All right, any other questions or comments on points? Okay, just looking at the clock here.
Good.
Good. Okay, so PMI. Now I've got a class I've been promising to teach, and that'll be in the next couple of months. The name of that class is having a PMA about PMI, having a positive mental attitude about private mortgage insurance. And yes, PMI is a good thing. You don't believe me? Jump in a time machine and jump back into 2010 when PMI was for the short term extinct in Northeastern Ohio, and you either had to have 20% down or go FHA. So I don't want to spend too much time on this. I'd rather just tease the PMI class, but PMI isn't just monthly. PMI can be paid in one lump sum, and that's a big part of the class that we put on there. So just to use a round number, let's say you have somebody buying a house for $200,000 and putting 5% down. Well, they can pay monthly PMI, which might be 30 or 40 bucks a month, or it might be $100 or $150 a month, depending on their credit and a bunch of other factors. Well, there's also an option where you can do a lump sum one-time PMI payment. That might be 2,500 bucks. So again, getting a 2.5% credit on a $200,000 house could cover the entire PMI. And say, again, same thing. You can't just put a blank note out there that seller will pay buyer's PMI, because that could be 800 bucks. That could be $10,000 because of how PMI is calculated and it's risk-based. But this is another powerful tool. And again, we have conversations. These are strategies that we can work with together. And I can give you long list of stories with agents who basically said buyer and seller were $10,000 apart. Buyer is in seller, just neither of them are budging. So how about if we have come up with $2,000? Can we creative use that towards a buy down or points or PMI to make this work and, come up with a solution where it is a win-win for buyer and seller. We'll call it win-win for the both agents, and hey, a title company and mortgage company in there. So I'm sure they'll consider it a win as well. And I'll give you one quick story. Had a customer who was pre-approved elsewhere, kept calling and asking me questions because they liked what I had to say, but they didn't want another credit report pulled. Finally, the other credit report with the other lender was expiring. They said, fine, Sean, I'll get pre-approved for you. I know I can only go up to $300,000, and that's where I'm comfortable. So just get me pre-approved for that. Where this story ends, they bought a house for $330,000. The listing agent came up with the idea of seller paid PMI. The end of basically what happened here is the buyer was only qualified and comfortable at a payment of, let's just say, $2,000. At 330, it was pushing the payment up to 2,200 or whatever it was. But because the seller said, I'll pay your PMI, that got that payment down to $2,000. So you think that buyer, and especially his wife, who was in love with this particular house. I mean, I can tell you the agent who came up with this, who learned this in a class just like we're teaching today, but to get to a $30,000 higher price at the payment that the other lender had them at for $300,000, it was a game changer, and I would say a life changer to these particular buyers. So we can get pretty creative, and creative is not a bad word, by the way. We can get pretty creative in coming up with different options and scenarios. And again, educating the consumer is really what we do. So jumping back into seller concessions. So we mentioned here, seller concessions should always be toward closing costs, prepaid items, and points. And as we just mentioned, thanks to Nancy's question, and buy down would be kind of a nice general phase to add in there if you have a buyer kind of exploring that. By wording it that way too, you may or may not have run into this problem. If you just wrote seller to pay, seller to credit, $3,000 towards buyer's closing costs, period, That excludes points, prepaids, and the Buydown. Especially if it's a bigger number, you want to include that just so it gives us kind of the buyer the free reign to apply this towards whatever they want. And the concessions can also come from realtor. I mentioned that here as well. So jumping into the rent versus buy. So I mentioned our webpage. With what we're seeing right now for 2020 and 2021, obviously it was absolutely crazy. And you had people running out of rental situations. I mean, I had buyers who said, I've been living in my apartment or for this house for 5 years. All of a sudden my rent is going up $200. Well, guess what? Now that rates have gone up, no matter what charts you look at, rates and rent, when interest rates go up, rent goes up as well. So when is it a good time to buy and not rent? Well, if you think you're going to be in a house for more than just a year or two, that buying calculation is oftentimes going to come out, especially with what we're seeing with rents. So there's a link on here that will take you to our webpage where you, if you're trying to make a point to your customer or your buyer, can kind of plug in a scenario of, okay, I'm paying this much rent, and if I wanted to buy a house of X amount, and it does a nice little comparison, and it shows them what you're losing in equity, what you're could be building in equity, I guess, or what you're losing as renting. And this is a pretty accurate and honest, and you can toggle the numbers. Okay, well, let me just assume there's 1% appreciation and that my rent's going to go up only 3% per year. Or you can toggle that saying, what if houses appreciate 5% or 10%, which might be a little extreme, but this is a great calculator. So if you've got some fence sitters or somebody who just may ask a question of, at what point do I decide it's a good time to buy, from a apples to apples financial. So it's a great tool on our webpage. So I wanted to make sure that we pointed that out. Really in any market, and especially in the shifting market, I think the niche is where to go. And wait, I wanted to steal Mike's quote from Tuesday. Something's in the niches. Does anybody remember what it was? The commish is in the niche. I don't know.
The riches are in the niches.
What was it? The riches are in the niches. There you go. Thanks, Heidi. The riches are in the niches, which is better than the commish is in the niche. So thank you, Heidi. Good one. And really, a buy down isn't necessarily a niche, but being that realtor who can bridge a gap. I mean, we've all been there or will be there, where you have a buyer and seller. Buyers aren't just willingly paying 20% over list price, after looking at a house online. So we're seeing deals come apart because of home inspections more than we have in the past. So being kind of that specialist on, being the agent who can bridge the gap or get us into the finish line, things like that. While you're in the buying and selling, that I would consider the niche. But from a lending standpoint, renovation loans. Most of the renovation loans we did over the past 2 years are because people couldn't find a house or get into the one they wanted. So they stayed and did a renovation loan on their current house. Well, now with the market turning, we're seeing buyers say, you know what, I want to buy this house, but I want to make it my own. Let's do a 203K. That's going to take 60 and maybe 90 days to close. That close period of time wasn't working for the last 2 years, but in the current year, we're seeing that. Construction loans. We do construction loans on VA, on FHA. I can't name another lender within 100 miles that can do that. They may exist. I just don't know who they are. We do investment properties. I did as many, I should say we, myself, Chris, and Don probably did as many investment loans the past 3 years as I personally did over the previous 15. Ohio is still desirable. Yes, prices went up. Yes, rates are going up. Talk to somebody and guess what? California and in Florida and in Massachusetts, that same is happening, but a much larger scale. So there are a lot of out-of-town buyers, but there's a lot of in-town buyers looking to get into that. Be a specialist for it. I could rattle off 2 or 3 agents who make their business primarily with investors, and I know sometimes even unwillingly, but they're there. VA loans. So I mentioned that. Don't be afraid of VA loans. If you all of a sudden, get a referral and says, hey, my friend Tom just came home for the service, and him and his wife are looking at buying a home. They're going to be giving you a call. Don't panic. If you want a 5-minute little pep talk, call any of the three of us and we can give you a rundown of what you want to and need to know for VA. You can send over one of our PowerPoints from our classes, and just know that we're a phone call away. So, whether you're knee deep in a deal and negotiations, or maybe you're, working with another lender and you're a listing agent and something is happening because it's a VA loan that you don't understand, that's what we're here for, is to help you and your business. But embrace the veterans in general, but all these loan options. USDA, if you're looking at property outside of Cuyahoga County, maybe in like southeast, eastern Jago or southeast Lake or eastern Portage County, did you know there's a 0 down loan program for home buyers? They don't have to be a veteran. These programs don't exist in a lot of other communities. So that was the main thing I wanted to mention on niches, which is where the riches are. Thanks again, Heidi. But any comments or questions on that? Okay, I flew through this pretty quick. If you take nothing else away, what I usually mention at the beginning and end of these classes are, you don't have to be an expert at any of these. Know that these options exist and kind of treat them as almost buzzwords. So if you're thinking, oh, geez, you know what? Somebody just said a Buydown might be, factoring in here. I don't remember how that works or what that is. Give any of us a call. We can kind of give you some guidance and walk you through it. If you're in that scenario of, hey, Sean, I've got a seller willing to sell this house for $200. I've got a buyer who wants to buy it for $200, but they can't swallow a $1,600 payment or whatever they're at. What are some ways to come up with this? Can we look at points? Can we look at buy-downs? Is there a trade-off? Don Jarecki is, I've overlooked this oftentimes myself, but I remember we had a testimonial come in. Hey, Don, thank you so much, blah, blah, blah. And I asked Don, give me some of the background on it. And it was this, and Don could probably certainly tell the story better than I can, but the scenario of, hey, you know what? You're spending every dime you can to put 20% down just to get, because you think you need to avoid PMI. Just for fun here, hear me out. What if you put 10% down? Here's what your payment would be. Here's what your PMI would be. But if you took that other, $20,000 or $10,000, whatever it is, and paid off your credit card debt or finished paying off the 8 months on your car loan, all these other strategies just to, look at monthly cash flow and just sort of, that debt relief. So Don, feel free to expand on that if you want. But anyway, there's so much more to it. Once you're really looking at someone's finances and their credit report, where if the deal is with us or it's not, we're more than happy to jump in.
I mean, really it is, Sean. I think all three of us, we're not just interest rate quoters, not closing cost quoters. We're going to look at putting the borrower in the best financial position possible. And years ago, when PMI was really expensive, buying out of PMI was the way to go. But today, when you have good credit, PMI is so inexpensive, it really doesn't make sense to do it, because you can use those funds in other ways to save money each month. So we're going to look at the big picture when we're working with somebody. Just know that.
We consider ourselves consultants, so to speak, as opposed to salespeople. And I think you all would think the same yourself. Realtors are salesmen, but I think you guys are much more than that, especially with all the hats you wear. Not to mention the emotions that you manage. So that's more or less what we had for the presentation. 5 minutes here still to spare, but does anything else you want us to touch on, or any questions, whether it's specific to what we covered today or just general market?
Sean, I have a question. Can you do a buy down on an ARM?
We do not. In the past, that was available. Cannot do buy down on ARMs these days. Back in the day, so where ARMs were very popular, late 90s, early 2000s, when we were in a similar rate climate. And at that point, you used to be able to buy down an ARM and qualify off of that. So if a 30-year fix was 7 and an ARM was 6, and you did a 3-2-1 buy down, they would qualify you at 3%. Those days are gone. But so yeah, answer your question, unfortunately not. Good question. Any other questions? Okay. Well, I appreciate everyone being here today. You know, like I said, I think each of you know us on some level. I would certainly encourage, if you guys want to expand on anything specific in here, anything general, anything loan related, you know, we're certainly happy to take some time one-on-one. We do face-to-face Zooms. We can meet in the office. Believe it or not, we're up for lunch and a coffee every now and then too. So happy to catch up with you guys. So thank you everyone for coming. I'll make sure, was anybody able to download the PowerPoint, the PDFs that I put in the chat box?
They were downloading for me once they got fully uploaded.
Okay, I may send them over to Carrie too, just in case want to redistribute those. But yeah, anyway, I always have a hard time closing when I have the floor here. But if anybody needs anything, just reach out anytime. And thank you so much.